Hello everyone, today is Friday, March 4th, 2022. My name is Evan. Welcome back to our weekly stock market analysis video series. If it's your first time tuning in, welcome. Thanks for being here. Thanks for joining us. Here's how these videos work. We break up our analysis into two parts. In part one, we go beyond price action. We look at things like correlations and the term structure of volatility, credit markets, interest rates, really sort of just pick apart the moves that stand out and look different or interesting. And then in part two, we jump into the charts. We look at those longer term trends, take a snapshot of price action and try and make some sense of where we might be headed. So hopefully that sounds good to you. Let's jump into some of the headlines, the takeaways from this week. When I say headlines, we don't really talk too much about the high level news items necessarily, but really sort of the noteworthy technical moves. And we started off here with stocks, and stocks obviously they ended up closing the week down here in the US markets, but they did spend the majority of the week sort of chopping sideways, and then they gave up those they gave up a little bit of the range or the chop to the downside on Friday. We'll talk more about that in part two. Interest rates, I think importantly here, are starting to cool off a little bit, or they're starting to really kind of pull back and sustain a little bit of a pullback here after a really strong move to the upside. And then we also had the US dollar surging to 52-week fresh highs here. So lots of demand for dollars right now, and we're continuing to see that trend extend itself to the upside. If we take a look at the numbers here, right-hand column, this is the 1 week numbers. A couple of things that stand out. First off was the international stocks. So we are looking at international stocks with this proxy here. So the ACWX ETF. So that's what we track. It's basically world stocks minus the United States, down 6.35%. And if you recall, we had world stocks that were actually starting to outperform on a relative basis against the US over the past 6-7 weeks or so. But that certainly started to mean revert this week, where we saw international stocks really sort of finally take a hit and finally start to maybe catch up to what the US was doing. So that was first off notable. Second part, we saw the Nasdaq lead the decline again here on the downside. We saw the S&P actually trying to hold up relative to the rest of the markets, but generally speaking, US stocks were down anywhere from 1.5 to 2.5% this week. If we take a look at market internals, there's some improvement here. So notice that these numbers have gotten smaller on the number of stocks hitting 52-week highs minus lows. Now look, there's lots of ways to interpret the data. There's lots of different measurements of breadth, and we've talked about that many times in the past. But this view here, so just looking at the NYSE number of stocks hitting 52-week highs minus lows, this is my preferred sort of intermediate term gauge on market health. And you can see that this is starting to, dry up a little bit in terms of the number of 52-week lows made. I do think that's notable. The trend is still lower. So we are seeing potentially early signs of, maybe some stabilization, but again, the trend is down. So we have to be careful with this, but it is notable in the sense that we aren't just, hitting 300 new lows, 400 new lows a day. So that is noticeable. NYSE cumulative AD line down 1,000 this week, and the number of stocks over 20 SMA, 41.46%. This is a little bit more of the color there on the 52-week highs minus lows. You can see, again, we've got this trend to the downside. That's bearish. Below the zero line, that's bearish. Now, if we take a look at the last 6-7 days of action, we're starting to flatline. So again, this is where we just want to pay attention. We want to take note, and depending on your time frame, there might be something to do here, but generally speaking, there's still a lot of negative on this chart. Sector performance. So really had two big standouts this week. Energy, 9.2% to the upside. That was a huge move. And then we also had utilities, almost 5% to the upside. That's also a huge move. This utilities, well, let's start from the top. Energy, of course, now is, geopolitical driven, and all of the chaos happening overseas. Again, hopefully everyone listening to this is safe, and friends and family safe, out of harm's way. But this clearly here is rocketing the price of oil. Energy stocks benefiting, utilities benefiting from the inverse sort of, or pullback, I should say, I guess, in interest rates, and starting to see that dynamic change on policy and maybe expectations on Fed rate hikes and all that good stuff. So 5% to the upside. Real estate, third spot here, almost 2% to the upside. Everything else more so in the negative territory. Financials were the biggest hit this week, almost 5% down. Technology, almost 3% down. That's a pretty deadly mix when you have tech and financials, generally speaking. And communication services down 3% as well. I included this view again, sector breadth. I don't know that there's too much interesting here because it is, almost as anticipated. But this sector breadth view is the percentage of stocks above a 50 SMA in each of these sectors. So this is looking individual. This is looking in aggregate here. How many stocks in the energy sector are above a 50 SMA? Well, it's 100%. Utility, 75%, big boost there, and consumer staples, 56%. Okay. If we start to go down this list, you can see healthcare, pretty even race here. Half the stocks are above a 50 SMA, half are below. But in this environment, that's still pretty darn good. Real estate, so on and so forth, all the way down. You can see consumer discretionary, only 8.33% of stocks are above a 50 SMA right now. You can also see financials is notable because financials was one of the top dogs here for a while. It was sitting in the top 3 for a handful of weeks, and you can see that has certainly dried up now. Only less than a third, almost a quarter of stocks are above a 50 SMA. So yeah, a little bit interesting there. Some of it's kind of intuitive based on where these ETFs are trading, but you can get a little more granularity when you start to look at the individual components like this. If we take a look at volatility's term structure, we've basically got backwardation into the weekend. This doesn't quite show it. I do take this metric in a different fashion, but I think if you were to look at the futures contracts, I believe we are in a clear sort of backwardation state where the front month VIX is the highest price over the next 6 months out or so. So basically, we still have fear here. We've got VIX now going out over 30. So there is protection purchased in the market. There is, expected volatility, expected, movements in the S&P 500 now are going to be, plus and minus 2% days. That's what we should expect when you see a VIX like this. I don't know what that exact number is, but it's, again, just elevated range. And so this, again, just goes to illustrate the fear that is out there right now with all that is going on. If we take a look at interest rates and credit, so again, this is one of the big highlights for this week because we did see yields cool off across the board. We can look at some charts later, but essentially you saw basically all those bond proxies doing very well this week, and that I think is pretty noticeable. Trend is still up, I think, for yields. I don't think we've broken trend necessarily, but we are starting to, give back some of those recent rallies. Dollar and commodities. So we had the dollar up very big here, mostly coming at the end of the week. It was up almost 2% looking at the UUP ETF, and surprisingly, though, I mean, we basically had all commodities here still moving higher. So again, usually this relationship in normal circumstances, dollar up, kind of commodities suffer. But of course, we've got some very interesting dynamics going on with the macro situation, geopolitical stuff. So we basically saw essentially a unanimous rise here this week between gold, silver, Bitcoin, WTI, crude oil, of course, big standout here, 20% to the upside, huge move for crude oil. Natural gas benefiting as well. So put it all together and you got a report card that's a big goose egg here. There's nothing really redeeming about the action that we see out there. I did talk about this notion of, remember, when things are so bad that it can be it could be counterintuitive, but counter trend opportunities can lend themselves when everything looks horrible. But this report card here, just objectively looking at the data, is an F across the board. Let's take a look at our trading system. So we've got 2 trading systems here at Trade Risk. Our top system, Merlin intermediate term trading system. This 86% invested is still a bit skewed right now. I haven't got a new chart to show on these slides yet, but basically we've got a good chunk of this exposure is actually fixed income. It's treasuries. So essentially no risk. Well, I don't want to say no risk, but not equity risk. It's U.S. government default risk, I guess. So that's kind of what we're looking at here. Our short-term tactical trading system has gotten much more neutral. It is leaning to the downside a little bit this weekend. So it's got 3 positions on. I think it's got 2 shorts, 1 long. So essentially it's pretty neutral, a lot of cash, and it's just, got a little more exposure on the short side, but basically not taking a strong stand given where the market is right now. It's staying very tactical, and, that's the way it likes to do. And it, generally speaking, likes these trading environments. It's had a good year, and is continuing to sort of pull the weight between the 2 trading systems. So if you want to learn more about those, we've got dollar trials, and we have a lot more education, members area, trade reports, all that fun stuff on the website. So check it out with the link appearing in the top right of your screen. And with that, we'll be back here in just a second with part 2. All right, let's kick off part 2 here. We've got TC2000 open. We've got our equity market grid showing. We have an indicator that we developed for TC2000 here. It's called our Smart Trend Filter. It is a multicolored dots that you see printed on all of these charts. Helps us measure trend strength, path of least resistance in a real just sort of objective way based on price and volume. You can see on all of these charts now, on all of these assets here, you can see we've got red dots printed. That is our sell signal. That is our bearish stance here on the market. And you can see for the Russell, for the Nasdaq, this is not a new thing, right? So basically prices going down or price action suffering should not be that much of a surprise. If you're, solely just sort of looking at this indicator here, that we've been in this sort of volatile state now for basically a month or more in both of these markets. The S&P 500, take a look in the top left here. It's only the second week down for it with that sell signal. This was the last of the U.S. averages here to transition lower. So again, a little more resilient here relative to the Nasdaq and the Russell, but basically, this is also now in the sell signal. And again, you can see international stocks really sort of, breaking down this week. As we talked about at the top of this video, you can see it was a down 6.35% week, and we get a fresh sell signal there on the weekly time frame. So that is the, objective sort of high level picture here. If we go down to the daily chart, we look at things a little bit closer, a little bit tighter over the past, say week or 2 of action. You can see we have a lot more kind of yellow dots printed in here, which basically shows that mixed signal sort of environment, or the, kind of fight that's going on right now. Basically with the S&P 500, we're still below a daily smart trend filter. So that's bearish. Prior signal is sell signal. So again, that is bearish as well. Same thing in the Nasdaq, basically trading below the smart trend filter. Prior signal is a sell. The Russell 2000's still what's been kind of holding up a little bit better. We've talked about this now the past week or 2. We've seen the relative strength, relative leadership in the Russell 2000s trying to stabilize here. It's trying to hang on. A couple of green dots printed in here. So that still seems to be the case. It was the first to break down. It seems to be the first to trying to stabilize. We'll keep an eye on that. And then again, you can see ACWX still getting hammered here on the daily chart, of course, as well. So let's now take a look at some price action. Let's get a little bit more specific on these levels here. And I want to, kind of clean up and go to our very simple view here, which is board number 8. This is where we've really been kind of, starting with our analysis. And this is, sort of levels that we've had drawn on here, the same roadmap we've had drawn on here for quite a while now. And basically, it's still this reference point of just below 4,300 in the S&P 500. So it's basically this nice little rectangular band I have in here. Call it 4280 all the way up to 4300. That to me is the key sort of support zone or level of influence that I want to see this market stay above. And even though, we had sort of a volatile week and we had lots of negative headlines and lots of reasons to want to just sell everything and walk away for a couple of months, we still had the S&P 500, in fact, holding over this 4,300 level. So again, this is where time frame absolutely matters, and your level of experience and what you're trying to achieve totally matters here. But for you, short-term, maybe more advanced active traders, I like the fact that we are still holding above 4,300, right? If you are able to, again, very acutely sort of key off of this area here and manage risk, and you can cut a loss, then, we are still holding above 4,300. More importantly, we're still well off of the lows from last Thursday. And I think is one of the key points I want to make this week. And again, time frame matters. I just really want to stress this because I don't want this to come off as, let's just buy everything. Everyone thinks it's fine. I do think, right, we are in still this pattern of lower lows and lower highs. I do think breadth is horrible. I do think we have volatility that is screaming 30 plus, which is not a place where you usually want to be, comfortably buying stocks and holding things overnight. So those are all the negatives. Those are all the reasons why, if your time frame's a little bit longer, if you're a little more hands off, you want to be, much more defensive and conservative in this market. However, for you active traders that are trying to find a bottom, that are trying to, capture short-term swings, I do still, respect or put my, a little bit of weight here that we've got lots of these candles that formed last week, high volume, sort of outside reversals, bullish engulfing bars, and they show up on the weekly time frame really well. They show up on daily charts, and they're still scattered everywhere. And for the most part, we are still off, and in some cases well off of those lows. And so that to me is still the loudest reference point here in the short term for price action. And so the fact that we are still holding above, 4280 or so, we're still well off of these lows. There is still some credit here. There's still some fight that the bulls can maybe get back up into this range and continue to chop around here. That was sort of our analysis last week, right? We had our analysis, which we came into the weekend last week right here. This is what we were left with. This outside reversal day and then a follow through day to the upside. And, basically our thoughts coming into this week was, well, look, we're back into this old choppy range. I'd expect chop between 4,300 and 4,600, and we could very well see the upper end of this range again. So flash forward to this week, and you can see it was essentially just totally sideways. I mean, we really did nothing this week in terms of the S&P 500. There were other markets that did better. There were other markets that did worse. But basically, the S&P 500 just moved sideways here, digested all the headlines and, events through the week, and then, basically closed around 43.28. So for me, heading into next week, 42, let's say the lows from today, 42.80 or so, that's going to be where I'll be paying attention. If we start getting closing lows below 42.80, then I'm going to start to say all bets are off and let's be a little more cautious. For those who want to give just things a lot more room, then your big reference point is certainly the lows from the prior Thursday, which is down here around 41.14. That breaking below that level certainly sort of negates all of the positivity that came out of that. So that's really the way I'm looking at it. Again, back in this choppy zone, and trying not to overthink the levels or the range or the emotional headlines as much as possible. The Russell 2000 once again here. So we had this little wedge. We broke down from it. We had this loud, again, last Thursday's big bullish reversal there. And then look, we're still about, let's see where we close now, 5%, give or take from the low of the day here last Thursday. So again, the longer we can hold up, keep a higher low up here and not, immediately roll back over, I think is constructive. Again, I do still sort of hate the fact that there's so much overhead supply right in this 210 to 230 area. So, this to me is again, the Russell is not all that exciting, even though it has been going flat a little bit longer recently. But I think, the sort of outlook there is still very much the same. The Qs here are the most on the fence of rolling back over. So basically, this 340 zone, this is where the Qs finally started to crack now and showed some relative underperformance. Again, glass half full tells you that we are still well off of the lows from that last Thursday. Again, about 5.5% from the 318 lows that the Qs made. But we are starting to, just a little more clearly lose the lower end of the range from January, lose this recent consolidation from this week. And if we see follow through next week, again, this is going to be certainly a drag on the market as a whole. So, as that sort of summarizes here, lower lows, lower highs, trend is, lower in the last 3 months, but we've got some signs here that there's a fight going on, and we're still just kind of waiting to see which way this tips for the next trending move. So hopefully that helps. That's sort of my thoughts there. If we take a look at some other markets, so a few other things I wanted to look at today. First was the dollar. So the dollar here, UUP, breaking out to new highs. Again, we closed off of the highs of the session, but still, throw on a weekly chart here, and you can see that the dollar just continues to trend up here. It's been up since really bottoming out in 2021, and it's been just grinding higher and really now starting to accelerate higher as the flight to safety, flight to dollars, King Dollar here is really sort of making a good move. We got TLT, so TLT and IEF, so these are bond proxies. These are U.S. Treasury proxies here. So TLT, remember last couple of weeks we had kind of the observation here that maybe finally interest rates were starting to top out. Maybe bonds were finally starting to put in a bottom. We talked about that on these two candlesticks here. Left us a little lukewarm last week with that call, given the fact that we had kind of an ugly action. And now this week, we kind of came in with some heavier volume and started to push up and start to, challenge maybe some of these recent trends, this recent, multi-month trend that has been in place here for treasuries since fourth quarter of last year. So we're starting to get maybe a little bit of confirmation, a little bit of reflex bounce here going on in TLT, and the same thing can go for IEF. If you look at interest rates, it's going to be the exact opposite. So you're going to see interest rates starting to cool off, starting to pull back, and it's something to pay attention to, something to see a change of character here in terms of what the bond market is telling us. So that is notable. And then, last but not least, let's certainly talk about oil here, which is just accelerating to the upside. Again, if we zoom out, it's just been on this, magnificent trend to the upside here, just kind of climbing the wall of worry. And now, you're seeing just tremendous amount of volume traded, and you're seeing this trend really start to extend itself to the upside. Let's see if we can put on some Bollinger Bands here. You can see that USO traded today completely outside the above upper 2 and 20 Bollinger Band here. So again, this is not a usual occurrence. Shows you that things are pretty stretched right now. There's some unique circumstances. There's sort of a buying frenzy going on, maybe capitulation in some respect, but this is certainly well worth noting here. And if we go to the weekly chart, you can see well above the 2 and 20 weekly Bollinger Band as well, which again just doesn't happen all that often for this type of commodity. And again, this is a commodity ETF. It tracks the underlying. So there's a little detachment here from USO pricing, but yeah, I think that's everything I want to talk about. Let's finish off here with some of the sectors and industries that were notable. And there's a lot here, so I'm not going to be able to go through all of them this week. So I will expand this list. You can just pause the video. You can take a look at some of these things yourself, and you can review some of the stocks that are in these specific sectors and industries. So basically, I'm going to expand the bullish list here. So you can see it's dominated by energy again, for good reason, of course. So a lot of the oil and gas, the specific industries and the sector as a whole is clearly, racing higher for all the reasons we just discussed. And then you also have just a lot of basic materials as well. So you got the agriculture inputs and aluminum, coal, all doing very, very well. And then you've got just a mix here of some utilities and maybe some consumer defensive. So all of that I think makes sense. And it really shows up again, this is a top-down kind of video, right? So we start off looking at sectors, and we got the sectors, we looked at breadth, and then we go down to the specific scans here, and you can see again they just all kind of reiterate the same thing. On the downside, so let's expand the list here. There's a lot more things that are negative here. So you can see that we've got really broad range. We've got a lot of consumer cyclicals in here. So these are things like apparel manufacturing and auto dealerships. We've got leisure, we've got lodging, we've got luxury goods, we've got real estate services. So a lot of these cyclicals are in here. You've got some tech, some semiconductors finally starting to get hit now, and that's in here. And then you also have some banks that are finally starting to creep up as well, all to the downside. So I'll leave that scan there, this slide here, so you can just run through these yourself. But that's it. I think that's everything I want to talk about. Again, it's a volatile time out there. So for some of you, that's probably a really good thing because, there's a lot more opportunity and ranges in markets. And then for others, it's more unfortunate because you just kind of have to sit tight and weather the storm. So wherever you are, $1, just know your time frame, risk management number one. And as always, I hope these videos are helpful. If you like them, please do subscribe to our YouTube channel, or you can always catch it at thetraderisk.com. We're always posting videos there. And thank you again for tuning in and watching. Every Friday, we do our long form market analysis series just like this. So be sure to check back in here next week, and I hope you have a good weekend. Thanks so much.